We're good? All right. Hey, everyone. John Boardman, joined by Andy Reynolds and Brian Burton. And we are here to talk about a topic that's been on everybody's mind last few days. Rory McIlroy winning the Masters, Grand Slam, right?
Yeah. Central Kentucky allergies and tariffs. Yeah.
That's right. No, in all seriousness, markets have been volatile the last few weeks, and we've had a lot of conversations with clients about the tariff situation and really every day there's new news coming out. So, even talking about it right now, something new could be breaking as we're discussing it. So I think we just need to kind of start at the beginning of, Trump was elected, came into his second term in January after a 4-year gap, obviously. So you want to start, Brian, maybe just take us from, where we were and some of the initial goals that administration has and kind of what got us here.
Yeah, taking a step back and just looking at the U.S. economy, although we are the envy of the world as far as the U.S. economy goes, there's still, room for improvement. And I think some of these areas are things that most all of us can agree on, right? We want to reduce the national debt. We would love to trim the budget deficit down from $2 trillion a year. We would ideally have lower interest rates in this country to spur economic activity. We would love to increase economic productivity, increase GDP, increase the competitiveness of our exports, manufacture more things at home, and ultimately rely less on the global supply chain, particularly for critical industries such as healthcare and tech and national defense. So that's pretty much what got us to this point, with the tariffs now being in the equation. And Andy, you want to touch on kind of where we see going forward?
Yeah, well, obviously all those things you just mentioned are super easy to solve and are solvable overnight. And so, I think those are big challenges, and they're all not necessarily new. We've been talking about them for a while. We've been talking about trade. We've been talking about China for decades. Yeah. I remember being a kid and my mom imploring me to learn about Japan and learn about China because they're coming. So what the administration is trying to do is solve some of those problems. Obviously, there are some who believe they're doing it really well. There's some who believe they're not doing it well, and we're not going to go there today. But what we saw in the back end of, or the initial phase of that, we saw DOGE come out and trying to solve, some of the overspending in the government. We saw tariffs coming out, where I think we can generally agree those are hopefully, and we believe, negotiating tactics. Whether or not any will stick, some will stick, all will stick. Like you said earlier, it's really a minute-by-minute scenario right now. We don't know what those will end up looking like. We've seen President Trump react towards the Fed and trying to get interest rates low, and straight up requesting Jerome Powell to lower rates. And there are many in favor of the way that this is being done, and believing that we've tried to negotiate, we've tried to talk, and it may just be an approach where we got to rip the Band-Aid off and figure it out from there and bring these things to the surface. The other side of that are people who believe that, yes, we are trying to do those things. Things weren't horrible right now, and we are creating an environment that may have unintended consequences and maybe rewriting the situation that we're in. So, where all this goes, we don't know, unfortunately, because there is some negotiating that's going on, hopefully, I assume. And there's a lot of moving parts to the next stage of this development.
Yeah, you said unintended consequences. Sort of getting back to the market last week, and really all of April so far has been really crazy volatile to a level we have not really seen since COVID. Having 1,000, 2,000 point moves negative on the Dow, and then a 10% rally when we had the, sort of, I don't want to say
I believe that was a top 3 move all time.
Had to
single
been.
day.
Yeah, had to have been. Those moves are just not something we're used to in the domestic markets. And I think that is just a perfect evidence of how difficult it is for, institutional investors, for corporate America to sort of navigate through this environment, really not knowing what the rules are going to be.
Right.
And if you think about corporate leadership, even if it is a negotiation tactic, which I think we hope it is, most economists don't believe that tariffs of this level probably are going to have a really positive effect on U.S. GDP long term.
Right.
There is some amount of consensus that we get our trade imbalances to some better level, that things could be sort of mutually beneficial. The issue, though, I think is just the level of uncertainty that it's created in the market, and it's very difficult if you're a CEO of XYZ company, to make a decision that is, in most cases, CEOs are charged with making decisions, not just for this year, but for 5 and 10 years in the future of the company. How you make those decisions if you really don't know what the rules are going to be. So, like onshoring manufacturing, sure, we want a thriving job market and productivity in this country, but how much certainty is there today of what the rules will be even 5 months from now, let alone 5 years from now, and if you're retooling your manufacturer? I think that, if you're thinking about the market response, I think as much as anything, it's just those uncertain moments. You think back to COVID, when the initial days of the pandemic, it was just, everything was completely unknown. We didn't know the magnitude of what it would be. We didn't know what it would take to get us out of that, and you saw the markets in free fall. It didn't necessarily paint the picture of reality, but it was just the way markets tend to respond when they just don't know what the future is going to look like.
And part of that uncertainty is the word,
Yeah.
Without a doubt. And part of that uncertainty is the way that these things have been enacted, and it's not just uncertainty of what will stick, what will last, but it's also uncertainty of come the next political leadership, whether they will be around or be undone, and whether these CEOs are going to invest in something that may be a lot of money and take 3, 4, 5 years to accomplish, just for that to be unraveled in a handful of years. So that adds further to that uncertainty. And then when you're trying to project cash flows of businesses, who knows what that looks like. Brian, you spend a lot of time following the stocks and whatnot. What are you seeing from, what's being shared out there by analysts and by other companies and just conference calls and whatnot?
Yeah, we're about 2 weeks out from the height of Q1 earnings releases, and what we've seen early on from some of these early reporters is that you're seeing forward guidance for earnings. Well, a couple different things. Some are pulling it all together. It's just saying it's impossible to forecast growth for the next quarter. You've also seen some companies that issue 2 sets of forward guidance. Some based on no tariffs, status quo, and then another set that are based on where tariffs stand today. So it's an interesting time for sure. You think about companies like Caterpillar or John Deere, who import a ton of steel, more than a ton, but they import a lot of steel, and now they're hit with a 25% tariff on that. What does that do? And how do you forecast where that's going to land when you really don't know the playing field at this point? So, look, tariffs, we've long had tariffs in this country. This is not something new, but the way this has been rolled out is unprecedented. Last year, I think we had a 2.4% tariff rate overall on imported goods. So think about that now with a base tariff of 10%. That's 4x right there, what we had last year. So, we've had tariffs in the past, but the moves in tariff rates have been gradual or phased in, whereas this is basically going from 2.4 to anywhere from 10 to 25%.
And I think it's fair to say there's some type of disruption that will come from that, right? With so many big things being affected, I think disruption to a business cycle, disruption to an individual business, to a sector, to an industry, That's the hardest part trying to predict with this is how far down the line does that disruption happen? Even if it's your example of steel, that affects Caterpillar, John Deere, and that has other effects down the line to, construction and building and, that affects jobs and that affects the consumer. And so there's so many layers to how this plays itself out. And then at the same time, knowing that, well, it all could be solved tomorrow. It all could be getting solved right now. We are not privy to all those conversations, and knowing, where the White House is with decisions that they're going to be making and the conversations they're having behind the scenes as well.
Yeah.
Yeah, I mean, I've heard steel discussed a lot. I mean, obviously, if you're a U.S. steel company and you're not importing, that's, you may be loving what's going on right now. But if you're an automaker who imports a great deal of steel, it's a real problem right now. So I mean, these big shifts like you're talking about, I mean, they sort of penalize one specific area of a sector and then might favor one, tremendously. I think, we're trying to tackle a conversation in a pretty short period of time on a conversation I think can get political pretty quickly, right? I mean, and we have clients that, are kind of all across the political spectrum. So I think it was sort of interesting to sort of pull some facts, and not just thinking about, opinions about it, because I think, how we all get our news today, unfortunately, a lot of times it's come in with a little bit of a political angle or through a political lens. That's, particularly if it's coming through social media. So I think it was interesting. I actually went back and looked and you may have heard this talked about, but George Washington and Alexander Hamilton were actually proponents of tariffs. But what was interesting about it is that they called for tariffs when it was related to, to create self-reliance on goods related to national defense, and then for infant industries. So industries that were going to be important and might have a big overflow to U.S. growth and economic productivity, help them get off the ground and get started. And then at some point, pull those tariffs back because they could then compete on their own. And so that's not exactly what's going on today, but when you start talking about those critical industries, you can see where that connection's being made a little bit. And I think COVID, the pandemic exposed, our reliance both in the supply chain on, certain areas of the world, but also on things that we needed. What PPE, I guess, was the acronym that we were all throwing around at the time for, masks and whatever it may be. And it also interesting, and I'm not going to just riddle off a bunch of facts, but I thought this was fascinating. China currently has about 30% of global manufacturing right now, and obviously we're much lesser share than that. But of drones, which is sort of a new area that we think about from for a national defense standpoint, 90% of the drones used in the U.S. are manufactured in China. Yeah. So you can see that there are certain concerns that are, being raised through this. So I think it wouldn't surprise me, and I think we've talked about this, do we end up in a place where some of these most sensitive industries, manufacturers, that we try to reshore some of that back in the States, or at least from a supply chain standpoint, we understand that we're diversified away from China specifically as a trading partner solely.
And at least have the ability to ramp something up. If there's several that obviously we're concerned about and want to be able to have the ability to ramp it up if we needed to. Whether or not we're in a trade war with China can be debated, and you can go back historically over the past decade, 2 decades, maybe longer. But ultimately, there are certain things that we do want to have the ability to do here if we had to. Tomorrow, today is not the time where we have to be doing these things, because it is good to have a global economy, and there are winners from that. But I think the big part of these tariffs is to try to bring some of that back. It's up for debate what all we want to bring back, and if we have a population who wants to be putting together sneakers, that's up for debate. But there are definitely things where we probably want to have the ability to ramp something up, or at least be producing more locally.
As Dave Chappelle just famously said, I want to wear Nikes, I don't want to make them. So,
Fair enough,
that's
yeah.
your point.
I was
Yeah.
reading, I can't remember the author for this, but he made a really good point. He said if you look back on the last 100 years of economic growth in the United States, we have always had this pattern of sort of relinquishing industry, once our country got to a certain point of, I would just call it quality of life or wealth or whatever you want to call it. And he pointed to that also allowed us to move into industries that were a little nascent at the time, like radio in the 1930s, jet travel in the 60s, and then like the IT boom of the 1990s. You have to think about globalization and trade and think about, had we maintained our emphasis on manufacturing, would we have had the labor resources to be able to dedicate and the education resources to dedicate ourselves to become the most innovative country in the world?
Right.
It really brings up a big philosophical question in many ways, is because a trade deficit, the term deficit, budget deficit, not good. Trade deficit, same word, but maybe doesn't have the same threat in itself just as a deficit alone. You can have a trade deficit with the person that you pay to mow your yard.
Right.
That doesn't necessarily mean it's a bad thing. So you start to think about what are the structural implications that come from having that deficit. And so I think it has created issues within the United States. There's no doubt. You can drive through small towns all throughout the U.S. and see the amount of manufacturing facilities that no longer operate. No one wants to see that. But philosophically, you also have to question some of the innovation we've had in this country and say, had we dedicated our resources towards other industries, would we have had the resources to innovate in the way that we have?
And it comes back ultimately to competition. Competition brings out the best. So there will be winners and losers, but getting back to the manufacturing, talking about manufacturing Nike sneakers, is there an evolution where, I think the answer is yes. Is there an evolution where Nike sneakers were initially put together, created here, manufactured here? They go overseas, they're manufactured there. Is there a day, and maybe not with Nike sneakers, but with something else, that robotics comes in, or AI, or some type of next generation, next level of manufacturing that we have not yet been forced to do? And if everything's here and we're just doing everything here, that competition will not make us take risks, make us find that next thought process of how we can do it better, how we can do it faster, how we can do it cheaper. You look at like AI, and if that's only being competitively developed in a handful of places, it probably does not evolve as good as it can evolve if it's a world competition.
That's right. Yeah, you think about, the chips that we buy. I think 44% of the logic chips that we buy are produced in Taiwan, and another huge percentage are produced in South Korea. You're talking about countries that are extremely vulnerable, that we may not want to have to rely on solely for that production. Listen, there's also things that we don't want to manufacture in this country and that we'll never be able to manufacture competitively. Small goods and widgets that, China, let's be honest, China is the gold standard for manufacturing right now. They've been doing it for decades and decades. They have flexibility in their factories to customize products that it would take forever for us to catch up to them in those areas. And I think a lot of us would agree that it's okay if we buy some things from other countries.
Right.
When there are inefficiencies here, right? Certain things we want to produce here, like I said, chips, pharmaceuticals, national defense, drones. That's a great point.
Yeah.
But not everything.
Yeah. So let's go back to the markets a little bit. We haven't talked about the bond market.
Yeah.
Talked a little bit about the equity markets, but as you guys observe bonds, equities, there have been some very few winners. There have been a lot of kind of losers, and then there have been some losers in this environment. What do you all, when you're looking at the equity market and also comment on the bond market, different conversation slightly, but what are you all seeing out there when you look at why some of these companies are participating differently than others. And maybe some that are different than just a typical risk on, risk off type of move.
Yeah, I mean, that's a great question. I think we've definitely, from an investor positioning standpoint, we've seen kind of this rotation out of the Mag 7 to a degree. So, your winners, big winners from the last couple of years that pretty much produced all the gains in the index have actually been the laggards this year. And that's not all just tied to policy. There are other things going on. Obviously, the AI, artificial intelligence cycle, took a step back. When we saw a new rival in DeepSeek out of China come on board, lost the hype cycle that AI's been in. Definitely took a hit, and investors may have lost a little bit of hope that the CapEx outlays can continue at the pace they have over the last couple of years. So that's part of the reason that you've seen this broadening in the market and participation, which is a healthy thing overall for investors. We want more companies participating in the upside. So that's one thing. We're also kind of focused on companies at this stage that have wide moats or kind of high barriers to entry. So, you think about your Apples, Amazons, Googles, companies that are most likely able to pass on price increases to consumers and be able to do that without too much pain. Those are companies that we think will probably do well coming out of this.
I was just going to say, I mean, markets have been on a really nice trend line, right,
Yeah.
for a couple of years. And I think, we had talked about, historic, valuations and how growth and a lot of the Magnificent Seven, that they were just starting to trade at, elevated levels, right, of concern. And so sometimes it takes another crisis over here to make people pay closer attention, to some of those issues. And I think the one, connecting it back to tariffs, I mean, one of the common, at least projections moving forward is that tariffs, at least in the short run or long run, may result in higher prices. Mm-hmm. Higher prices, inflation, where the consumer just is facing, more expensive grocery bill or anything that they purchase. The Fed was positioned, and I think the market was pricing in a number of cuts in interest rates by the end of 2025. And was it yesterday Jerome Powell came out and spoke and said, or was it this morning?
Yeah.
It's hard to connect these days.
Yeah.
And said, it's kind of a pause button time to kind of figure this out. I mean, there's really not a great deal of motivation from the Fed standpoint to cut rates, because if they see inflation coming in a big wave, they're going to want to either stay the course or potentially do the opposite. I mean, that's what we used over the last several years, and we felt like we're kind of in the latter innings of this soft landing that everyone was, hoping for, and now getting to the point right before, the plane has landed, now facing this issue of potential inflation. I mean, we haven't seen it in the data just yet, but I think that is you would have to presume, if you're the Fed, that if the tariffs end up becoming more permanent, that inflation is just going to be the reality of the outcome that comes from that. So I think all of those things, valuations, potential inflation, lack of interest rate cuts, like all of that, I think exacerbated it. And then you talked about the bond market. I think one of the unexpected consequences was just, I mean, I don't know if we have the exact numbers on the sales of U.S. Treasuries, but I mean, I think that was what was happening when we saw the 10-year pop up, over the last week, although it's come down a little bit in the last few days. So I wonder if that's what spooked the administration a little bit. They came out and said they were not greatly concerned about the stock market specifically, but the bond market, that creates a whole other issue, I think, that could get completely out of control.
And the bond market often says more than the equity markets. Yeah. And I just want to go back real quick. So the Fed, I think there's a higher and higher likelihood, the longer this lasts, that the Fed could be pulled in two different directions based on their dual mandate. So one part of it may say the economy's softening, we're seeing, the recession word, I think it's overblown. There are lots of different types of recessions. But if we start to see a consumer, a jobs, that start to be challenged, while at the same time we're seeing inflation.
Stagflation, basically.
So exactly. What do we do? How does the Fed react to that? You know, I don't know which, and I don't think they know. I mean, Powell mentioned it in his press conference. He's like, this is one of our biggest concerns, and we don't know what we would do. That is, you go back to the 70s, and we saw a little bit of it during COVID, but stagflation is the biggest concern, where you have, you know, inflation going up and you have growth that's barely changing.
Or a shrinking economy.
And yeah.
I mean, in a worst case.
Yeah.
For sure.
And so how the Fed handles that, I think will be interesting. Going to your comment about treasuries, you know, I think a part of this also is there's a lot on the table, right? We don't know exactly where this is going. It could be done tomorrow. It could, these tariffs and negotiations could go on for a year, you know? So part of the treasury part, and also looking at the strength of the dollar, is where does the U.S. stand on the back end of all this? And the back end probably isn't a month from now. It's probably as all this plays itself out, because it has been brought to the surface at this point. Where does it all go, and what happens with treasuries? I don't know that, correct me if I'm wrong, but I don't know that we exactly know yet what caused the treasury market last week, the yields to go up.
I mean, it could be inflation expectations. It could be selling of U.S. I mean, it could be, and probably a combination of a lot of factors.
Yeah.
I think, you know, if we'll ever know, that's more than likely what caused it.
Yeah. And so just, we have to, you know, be aware of those things as well, and aware of where the dollar stands and where our treasuries stand. And there's arguments for both, a strong dollar, a weak dollar. It just kind of depends on what else is going on out in the environment.
Yeah, I mean, I think from an investor standpoint, just kind of pulling it full circle, I mean, we've never been huge advocates, particularly in like wild weeks like that, of trying to trade in and out of a market like that. I mean, that's just sort of a thankless pursuit, right? I mean, and we saw the whipsaw of the market, you know, over that period of time. And we're not telling people just to sit on their hands, but, you know, we feel like kind of going into these environments that we're never anticipating that we come in every day and the sun is shining and there are no issues in the world. And like volatility of the markets does comes out of nowhere. And so, and oftentimes when people are most complacent because things have continued to go well. So, you know, proactively positioning people in front of these types, and we feel like we've done a nice job doing that. You know, it's making sure that people are positioned in anticipation of volatility, not feeling like we have to react in the middle of a chaotic environment. Now, this type of environment can expose some value opportunities. I mean, I think that's what we're trying to focus on now, is just, you know, this too shall pass. You know, we'll get through this window, and thinking about what the economic environment and the backdrop may look like on the back. That's a little harder to predict right now, but there will be a time when human ingenuity perseveres and these companies navigate through it, whatever the rules may be. So I think it's about positioning ourselves and our clients in light of what the future may hold, because most of our clients they're worried about the next 6 months, but they're in this for the next 15, 20, 25 years, 50 years in some cases. And so I think making rash decisions in the short run, I think everyone knows that, but it's easy to forget that in these moments when things just sort of get crazy.
Yeah, no doubt. I mean, the good news, well, there's more than one bit of good news, but definitely one piece is that we came into this situation with a great economy, with a very, very strong labor market. You know, markets were near all-time highs. So, you know, had it been a different situation coming into this, it could have been much more painful. Not saying that we're done by any means. I think we're likely to continue to see volatility in markets until we get a more clear path on what the playing field is going to look like. But like John said, that's what we're prepared for.
And I know out there in the media and whatnot, you know, there's been talk about the 1930s and whatnot. I don't think the world is so different today than it was then. And if we can get through COVID and we can get through the dot-com bubble and the financial crisis, you know, the odds are the worst case scenario that some people are worried about in the moment, high probability it's not going to happen.
Yeah.
So looking for those opportunities, looking to make good decisions. You know, I wrote down, what could people do now? stay the course. This is a great time to rebalance. It's a great time to be looking for value in underpriced, mispriced positions. It's a great time to just remain unemotional. It's not, in most situations, doomsday will not occur. Hopefully it never occurs. But, I don't think we can scare ourselves into positions that more likely than not won't occur. And look at your liquidity needs. If you are concerned and you anticipate in the next 6 months, next year needing something, let's just go ahead and get the money out now and put it on the side. We don't want to take all of our money and do that, but if you have something coming in the near future, just go ahead and do that. If you want to take your RMD now, take your RMD now. The market's down, but it's not down. We're not down 50%. So it's a good time to be just thinking positively of what good decisions you can do. If you need to gift, now is maybe not a bad time to think about your gifting for the year. So there's always good opportunities that can be done, whether the market's really high, economy is doing great, or whether the market's low or lower. And there's always good opportunities that can be done from a planning standpoint, no matter what the market's doing, whatever, no matter what the economy is doing.
Yeah, I think, we had a meeting earlier and just talking about how much, I think this has just been a lot for a lot of people to digest. It's been a lot. We're not accustomed in this country to a lot of swift change, and I think it has been a lot for people to absorb. And so I think what we're attempting to do today is just to have a conversation, just sort of like, let's just take a breath and just, have some perspective on how, this can be navigated. I don't think it requires swift decision-making or trying to circumnavigate around, this period of time because, from an investor standpoint, what we know is that, markets like to surprise the most amount of people at any given time. So, at the point of complete despondency, and I'm thinking back to the trough of COVID or the trough of the financial crisis in March of 2009, those were wonderful opportunities, if you were willing to have a long-term view in the face of fear. And so we don't know if the market volatility is even close to over. It could accelerate from here. But I think to react in the midst of it, I think would be a fatal error for investors.
Yeah, and I think to your point, the economy is never perfect, but we're in a pretty good shape where we were. If we recognize there's some things we can improve on, when's a better time to try to improve? It's better to try to deal with some of these issues now when we're in a decent spot than when we're forced to. Yeah. And so I think there's positiveness that can come out of this. How and when, we don't know.
Yeah, that's exactly right. Well, we appreciate you all listening in today. Obviously, reach out to us at any time if you have any questions that we can answer. If you want to have a deeper conversation on the topic, ask one of these guys. Take care of you. Thank you.